The 5 biggest tax strategies for LLCs and self-employed individuals. Hey, my name is Sherman, the CPA, and today I want to give you some tax strategies that can help you save thousands of dollars and keep more of what you earn. A lot of business owners I work with don't think about tax strategy until they get slapped in the face with a tax bill that they were not expecting at all. And by the time they file their tax return, it is too late for them to take advantage of some of these easy tax strategies that can put more money back into their pockets. But that is not going to be you today because you decided to click on this video. So make sure you watch it until the very end, and I promise you will not regret it. By the way, if you're new to the channel, make sure you subscribe for even more ways to save money on taxes. We have over 300 free videos on our channel that can help you. All right, so the 3 big taxes that all self-employed individuals pay are federal income taxes, state income taxes, and self-employment taxes. Now, all of these taxes are based on your income. So the tax strategies that you are about to learn today will help you avoid some of these taxes by changing your business structure or by reducing the amount of taxable income you report on your tax return. So here is the scenario I see the most often with small business owners. Number 1, they are paying 3 times more self-employment tax than they actually have to pay. Number 2, they are missing several basic business tax deductions. Number 3, not converting personal expenses into business tax deductions. Number 4, not deferring their income to lower their taxable income. And number 5, not using a defense system to protect themselves against IRS audits. Okay, so for the rest of this video, I am going to give you the keys to fix these problems and unlock more tax savings. So let's go ahead and begin here. Tax strategy number 1, avoid self-employment tax. Self-employment tax is the tax that surprises most small business owners. It is something most people don't think about until they get their very first tax bill and owe money. Hey, you owe $20,000 in taxes this year. What? How is that possible? Well, you have $10,000 in self-employment taxes. Self-employment taxes, what? All right, so what is self-employment tax? Self-employment tax is a 15.3% tax on your business income to replace the Medicare and Social Security tax you would normally pay in an employer-employee relationship. Except now, since you're self-employed, you have to pay both the employer portion and the employee portion on 100% of your business income. So if you earn $100,000 in business income, you would pay $15,300 in self-employment tax. But in this same scenario, you can cut this tax by $10,000 by switching to an S corporation. S corporations do not have to pay any self-employment tax at all on its business income. Instead, the owners of S corporations must take a taxable salary from the business and pay Social Security and Medicare taxes on the salary they take from the business. But the salary you take can be as little as 1/3 of your business income, which means you can cut 2/3 of your self-employment tax by simply switching to an S corporation. If you want to learn more about how this works, just drop me a comment below. Tax strategy number 2, deducting almost everything. A lot of people ask me questions about what they can deduct to lower their business income. But what if I told you that you can deduct almost all of your business expenses? Well, you can. Section 162 of the Internal Revenue Code specifically states that you can deduct all ordinary and necessary business expenses you incur for your trade or business. So let me ask you a question. Are you deducting everything you buy for your business? No, like seriously, everything. Let's talk about what ordinary and necessary business expenses are And then you can figure out everything you can buy that meets this criteria. So look, an ordinary expense is just an expense that is common and accepted in your business or trade. For example, let's say you went out and bought a $100,000 printing machine. Now, this might be an ordinary expense for a paper company, an advertising company, or maybe even a t-shirt design company who prints designs on their clothing. But on the other hand, this might not be an ordinary expense for a car mechanic or a gas station. They would likely have a hard time proving that a $100,000 printing machine benefits their business. Now let's go ahead and talk about necessary expenses. Necessary expenses are expenses that are helpful for your business. The expense should help your business do something, ideally increasing your revenue or perhaps improving your operations. For example, technically, business travel is a tax deduction, but you just can't travel to Hawaii and write off all of your expenses. No, you would need to show why it is necessary for you to travel to Hawaii. Specifically, how does traveling to Hawaii benefit your business? Are you going to a trade show, conference, or meeting with business contacts? Whatever you do, it needs to be necessary for your business. Now, here is your tax strategy. Look at all of the expenses you pay for, all of them, even if you bought something personally, and ask yourself, did this expense benefit your business in any way? If it does, then there's only two other questions you need to ask yourself. Number one, is it necessary? And number two, is it ordinary? If the answer is yes to these questions, then ask your CPA how you can deduct it from your business taxable income. Comment below and let me know something that you bought and want to deduct. Tax strategy number three, converting personal expenses into business expenses. The IRS allows you to deduct personal expenses that you incur, like home expenses, car expenses, travel expenses, even your cell phone and Wi-Fi expenses under one condition. There must be a business purpose associated with those personal expenses. In general, you can deduct the business use of a personal expense. Now, in order to do that, you need to find out the business use percentage of your personal expenses. An oversimplified formula to do this would be to take your business use divided by the total use for that expense, and that would equal your business use percentage. Then you would just take the total amount of all of your personal expenses, multiply it by its business use, and the answer would be your tax deduction. For example, if you use 25% of your home exclusively for your business and have $50,000 per year in qualified home expenses, then you can deduct $12,500 in home expenses as a business expense with the home office deduction. $12,500 as a tax deduction would equate to over $3,000 in taxes saved if you have a 25% effective tax rate, for example. And this is just one of the many things you can deduct. So the strategy here is simple. Add a business purpose to your personal expenses to convert them into tax-deductible expenses for your business and pay less taxes. Now look, I just simplified the crap out of this strategy. So before I move on here, I have to give you this disclaimer. The IRS provides specific rules for taking certain deductions like the home office deduction, the vehicle use deduction, travel deductions, and so much more. So don't go out there without doing your research or without professional help. But if you are enjoying my teaching style so far, then consider joining my Tax Savers Club, where you will get access to my exclusive Tax Savers course and monthly training sessions with me to keep your tax plan in tip-top shape. Just go to mycpacoach.com to learn more. All right, tax strategy number 4, deferring your income. Deducting expenses from your income is not the only way to reduce your taxes. You receive tax deductions for deferring your income into tax advantage accounts. Now, I personally love this strategy because you can effectively reduce your taxable income by simply transferring money into a different account. This strategy basically costs you no money, plus the money you transfer to these accounts can be invested into assets to create incredible wealth for you in the future. So what are some examples of tax advantage accounts, you might ask? Well, there are a few big ones that I almost always recommend. All right, number one, an HSA or health savings account. With this account, you can get up to a $7,200 tax deduction for simply putting money aside for health expenses, which 99% of people will have in their life anyway. Number two, solo 401k or SEP IRA. You can get up to a $60,000 tax deduction for putting money aside for your retirement as a business. And number three, the traditional IRA. You can get a $6,000 tax deduction for putting more money aside for your retirement as an individual. Just by using these accounts alone, you can increase your tax deductions by over $70,000 here. So for example, if you have a 25% effective tax rate, then that would mean you would save $17,500 in taxes alone just by using this strategy. All right, tax strategy number 5, protecting yourself from IRS audits. If you are going to adopt an aggressive tax strategy, you need an aggressive defense system to protect yourself. A strong system to protect yourself will give you even more confidence to leverage the strategies we have discussed so far. So this is what I recommend you to do at a minimum. Number one, make sure you are following the right rules. This sounds simple, but your tax plan should comply with the tax law. Every single tax strategy that I recommended to you so far in this video is completely legal, but you can get into some serious trouble if you start implementing these strategies without understanding the law. So make sure you seek a good CPA or study the instructions for each deduction carefully. You can find both at mycpacoach.com. Number two, keep up with your documents for your deductions. It is your responsibility to prove the accuracy of your tax return, including your deductions, in the event that the IRS questions it. Make sure you understand the threshold for documents you must keep up with for certain expenses. Also, for certain deductions, like business travel, you are required to keep up with additional information, such as diaries and logs, for example. I have another video on this channel that discusses this in better detail, so make sure you subscribe. But anyway, the point here is to keep up with all of your receipts, invoices, and records in your accounting system so that you can furnish supporting documentation at a moment's notice. Number three, maintain a good bookkeeping system. Use a good accounting system to maintain your financial records. A system like QuickBooks, for example, can sync with your bank account to help you prepare your books and allow you to attach documentation to your records to support your transactions. By the way, if you want a discount on QuickBooks, then check out the link in my bio. I have a special discount code for you. But as for these tax strategies, that's it for now. Thank you for watching today's episode, folks, and I look forward to seeing you in the next one.